welcome to Buy Wholesale, where we're going to talk about long-term trading options for an everyday investor here in Australia. Today we're going to look at an unrated company on the ASX that hasn't really got too much media attention, but based on their past year's performance, I think they're a steal for your portfolio. So the company we're looking at today is Uniti Group. You may not be familiar with them since they're a smaller telco, but they do have a big presence in the major cities of Australia. They're basically like any other telco, but they're fairly new compared to other providers. But you may have come across Uniti Wireless, which is their broadband arm of the business for the everyday consumer. In addition, they also have some tailored offerings for small businesses and retailers. But they don't just address the consumer market. They also support wholesale and infrastructure projects, offering fiber networks for builders, developers, and the government. But finally, they also look at inbound specialty services like data analytics and call tracking for small to medium-sized businesses, their key brand in this domain being 1300 Australia. Based on their past year performance, this line of service is definitely booming in the business, but we'll cover that later when we look at their performance for 2020. But that's just a little bit about the firm at high level. If you're still confused, think Telstra and Macquarie Group Telco if you're looking at competitors. So to start off with, we're going to compare Uniti's one-year performance from 2020 against 2019. One of the first things I look at is revenue, and what I really want to see is a year-on-year stable performance in revenue and profit. If we check out Uniti's annual report for 2020, we find that their revenue was up by 306%. Now, a lot of companies have increasing revenue, but what makes Uniti even more special is that 90% of their total earnings are recurring in nature. This is a good sign for future growth. The firm's cash flows have also improved significantly compared to prior years, and their cash balance increased to 189.2 million. The company is also currently debt-free as they recently repaid the South Australian state government. Compare this to Telstra and their 2020 annual report, and we quickly see that their debt and leverage is only growing at an unsustainable rate. So that's their overall performance changes, but I also want to assess how their individual business streams are performing financially. So to get started, in terms of their specialty services such as call tracking and data analytics, this had the biggest improvement in sales by 2,879%. Specialty services also generate stable free cash flow at 99%, which makes this a pretty safe and strong business area. The company also clearly states that this is a continued growth area into 2021 and beyond. Uniti has achieved a phenomenal level of growth by acquiring some major players such as Phone Dynamics, Call Dynamics, and their key brand 1300 Australia. Next, if we take a look at their consumer broadband service, we also see strong growth rates with revenue increasing by 77%, net profit also increased by 218%. Again, compare this to Telstra, who are currently seeing falling revenue and profit levels, plus they've only really maintained market share from their involvement in the NBN, which is a one-time spike in their income. Because of their shrinking profits, Telstra are under pressure and are quickly looking to diversify into new digital areas, and this is where I think Uniti can quickly outdo Telstra in the long run. I can only anticipate Telstra's market share to continue to shrink. However, not all has been fantastic for Uniti, and management has had their own fair share of struggle. So although the company had amazing growth in revenue and profit, this was significantly offset by those acquisition and restructure costs. If we look closely, we can see that their costs shot up by 2,693% in 2020 due to their internal restructure. And although that sounds bad, this is actually pretty promising for their future, since management clearly knows how to hold cash and grow the business despite having major structural costs. I think it's an amazing effort by management. I also find that it's good to do a little bit of stalking on the management's involvement in the ASX to make sure that the company is buying rather than selling big chunks of their share. If we look at the past 3 to 12 months, we can easily see that significant amounts of insider buying by their executive team. It's also a good idea to quickly check the overall breakdown of shares to make sure that there's some private institutes that own the company, since they tend to be more risk averse and prefer buying into the long run compared to the public. Looking at their share breakdown, we see that 24% of owners are private institutes, but the majority of shares are still owned by the public. Despite this, I'm still pretty satisfied with the blend of ownership on the company. In terms of the overall telco market, Uniti does face competition from resellers of the NBN and mobile operators currently delivering 4G and 5G. but I think Uniti are in a position to brand themselves as an upcoming leader in this space. Next, if you look at their competitor prices, we can see that Telstra is at $3, and at their best back in 2017, they were around $5. Macquarie Telecom Group, who is also doing really well right now and is another company to keep an eye on, is sitting at approximately $49. However, instead of being valued at double digits, they've been priced between $1.5 to $2 over the past year. So there's definitely a lot of room for Uniti to match some of these competitive figures in the long run. Finally, what really makes a company boom is often the internal management. I would keep an eye on any major structural changes in the management, since the current team is doing a great job, and let's hope they continue to do so into the future. So their financials look good, management's amazing, they're strong against their competitors, but we want to make sure we're not buying this company at the wrong time when they're already reached their premium. In my opinion, based on their earnings and rate of sales, their PE growth is relatively low compared to their underlying growth rate. The company is definitely undervalued between $1 to $2, and their forecasted earnings potential is promising. For today's market, I would definitely place a buy and review every quarter. Their most recent quarterly update for 2021 has also come out, so make sure to check that out. I hope you become an owner of these shares just like myself, because they're definitely set to make some money. Thanks for watching, and stay tuned for my next video.